evening, everyone. I welcome you all to today's webinar, and I hope we can give you some tax knowledge and insight to help you to be able to achieve your expectations. I started working in Nestle. So I did 3 years working experience there. And out of my 3 years, 2 years was management training program where I understudied the finance functions in Nestle, Ghana and Nestle Central West Africa. So I did 3 years there. Then I had opportunity to move on to join Ericsson, that's a telecom vendor, in 2009. And I worked in Ericsson for 8 years. I started there as a company control specialist, and I ended there as a project finance manager. So 8 years in Ericsson, and then I had opportunity to move to another company, just a short stint of 3 months, a company called Distill Ghana, which is no longer in existence. Then currently I find myself in an organization in the Free Zones Enclave, that's Bungi Lodes Cockland, where I serve or I handle the financial planning and analysis for a manufacturing entity. So what is taxes? What is taxes? So in the first place, taxes, we all know they are mandatory payment, which a government levies on its citizens and entities that applies within the boundaries of that country. And we pay these taxes without enjoying any direct benefit in return. So for instance, if you walk into a supermarket and you make purchases of some items, you'll be given a receipt of all the items you have purchased. But in that receipt, you will see some indirect taxes there. But you will not find that tax as part of the items that you purchased from or you took out of the supermarket. So that's what we mean by you don't see any direct benefit out of that. So that's taxes for you. From this definition, it gives us some key attributes of tax, which makes it unilateral levied. The government does not have prior discussion with any individual. They may have some engagement with some SOEs or some group of people, but mostly taxes are levied unilaterally by the government. And then it is usually imposed by a government agency. So in Ghana, we know that the GRA or the Ghana Revenue Authority handles the tax collection in Ghana. And it's mostly in monetary terms. Every tax that you have to pay, you have to part with your money. So you have to pay money for that. And any tax that is implemented should have a legal backing to it. There shouldn't be any tax implemented in a country without a law backing it. So those are the attributes of the taxes. Purpose of taxation. So why do government levy tax on its citizens or entities? The main one is to generate revenue to finance its expenditure. A government may draft its budget for a year as to how much they want to spend and how much they want to earn as revenue. The revenue bits usually are derived from taxes that they levy on you and I that we pay. So if a government wants to pursue an agenda to construct roads, to expand its roads construction, then the taxes will be what they'll fall on to pay that. So your taxes that you pay, you may ask, why am I being taxed so much on my pay slips? And this is one of the reasons that the taxes are levied. Public sector wages, we are being made known that government is the largest employer of workers, and they are able to pay these employees through the taxes that they collect, and also to service our public debt. Whenever we need to take additional debt to support our budget, we need to service that debt in terms of paying interest, and these taxes are also used in servicing our debt. So what are the purpose? So if a tax is implemented efficiently, it will help us in narrowing down our budget deficit. So if our expenditure as a country and our revenue as a country are not able to match, government try to implement additional taxes to take care of the gap. So taxes are also used for that. In other sense, taxes are also used to redistribute wealth. So as the saying goes, the higher you earn, the higher you pay. So as per our graduated tax rate, or the tax that employees bear on their salaries, the more your salary goes up, the more taxes you pay. So that's the progressive nature of the taxes. And it's also used to shield local industries. If a government wants to protect the local industries from foreign competition, it implements taxes on the foreign goods to make it more expensive, so that people will go in for the local produce goods. And it's also used to discourage consumption of other commodities such as alcohol and cigarettes. Next, I want to give you a brief overview of the 2025 budget statement government presented. There were some key tax measures that you and I'm sure some of our participants on the call may have heard one or two of them, but I also take the opportunity to give a brief overview on those measures as well. So basically, when government draft the budget, the main aim or the main agenda is to be able to optimize the revenue mobilization by broadening the tax base. So those are the things. So what are the measures in the 2025 budget? Currently, our minimum wage as a country has been revised a bit, and this makes our tax-free band for each employee has risen from the previous 490 cedis per month to currently 539 cedis. So this means that every employee, your first salary, your taxable amount, 539 cedis, is taxed at zero. So you don't pay tax on that based on the new amendment that was instituted in the budget, which has been passed by Parliament already. And no, this is yet to be effected in the payroll run of various entities. I think it might come into force the coming month. We all know that the withholding taxes on our lotteries, that was also abolished. Gaming and betting, whenever you stake and you win, your winning stake previously attracted a 10% withholding tax. And government is saying that it's no longer going to take this 10% withholding tax, is going to take it off. It is already taken off. And I think there are people attesting to it. Sorry. And also, there's also a removal of 1.5 withholding tax on the proceeds coming from the gold of small scale miners. So our small scale miners, whenever they get their gold and they sell, there was a 1.5% withholding tax. Government saying is taking that off. Then the almighty e-levy, which has been abolished. Whenever you make an electronic transfer now, this 1% is no longer there. There's also a removal of the emission levy on industrial and vehicles. And then the VAT on the insurance premium of motor vehicle is also removed. So from all what I've mentioned, you can see that these items which were previously giving government some form of additional revenue has been taken off, and is in a way creating a gap or a hole in the government revenue mobilization. But the government has also introduced a new, or has revised, the growth and sustainability levy, which was previously there on the extractive mining, from the previous 1% to 3%, meaning that when you go to our mining companies, what represent their gross production, 3% now is going to be taken from their production as a growth and sustainability levy to support government budget. And from this, the initial clause, or the sunset clause, that was applicable to this levy was to end in 2025, and this government has extended it to 2028 as well. So we're going to have revenue mobilization from that. There's also a special levy on importation, which was 2%, and it also had a sunset clause of 2024 extended to 2028. And one of the also key measures introduced by the government to able to take care of the gap that is created by the other taxes abolished is to increase the refund ceiling on our total revenue from the previous 4% to from current 6% to 4%. So the refund here was that whenever GRA collect all the taxes, they were supposed to set aside 6% to take care of tax refunds from companies who have already maybe overpaid or have some duty drawbacks to take. Government is now reducing it to 6%, thereby creating room for additional revenue to take care of government expenditure. Going forward, government is promising to also revise our VAT or create some reforms in our VAT. So they are going to reform the COVID-19 and able to also reduce the effective tax rate on a VAT, and the possibility of maybe removing the flat rate of VAT as well. So this is yet to be discussed, or maybe to arrive. Discussion is yet to be concluded and also introduced. Next, I want to give a brief overview on individual taxation. If you're an employee and you work, at the end of the month, your payroll or your pay slip, you'll see some taxes being taken out of it. So what are these taxes? How is the calculation done? What are the rules or the legislation governing this PAYE? So what is this PAYE? We call it pay as you earn. It's just like pay as you view. The more you view, the more you pay. And here, the more you earn, the more you pay taxes as well. So the individual is deducted this tax at source by the employer, and these taxes are levied on all incomes on the individuals in employment. So here the emphasis on all income of the employee, whether it's received in cash or it's given to you in kind. So the law says that all your earnings must be quantified, whether in kind and in cash, put together, and the tax will be slapped on it. And the PAYE, when the government or the employer collects, he needs to remit these funds or file this to the government through GRA at the following month on the 15th day of the month. And the rate that is applicable or in calculating the PAYE is what we call the graduated individual tax rate. So this slide, if you can see, gives a brief or a snapshot of the monthly applicable rate to our employment income. So what this table is saying is that whenever your assessable income is calculated or your income earned is calculated, and you have the taxable amount, out of that amount, 490 cedis is taxed at 0%. So out of your taxable amount, we will be taking 490 cedis at zero tax. The next 110 out of your assessable income is taxed at 5%. And your next 130 cedis will be taxed at 10%. Then the more you go, the rates go up. So after 130 cedis, you go to 3,167 cedis, will be taxed at 17.5%. I hope you are all with me. Then 16,000 cedis will be taxed at 25%. And then the next 30,520 will be taxed at 30%. And any amount exceeding 50,000 cedis a month will be taxed at 35%. So you'll see the tax amount for each of the band, and cumulatively you see how much the tax rate is being added on the cumulative income is added on, and your tax rate is also added on. So this is the applicable tax that we have in Ghana. This will be revised based on the new minimum wage that has been passed. So the 490 here, we should expect it to increase to 539. So allowances and benefits. So in calculating your PAY or your tax applicable, any form of allowance that you are paid in cash is added to your salary and tax. And as well, any benefits that you receive in kind are also considered for the taxation purposes. But however, these benefits in kind are assigned or given a monetary value before they are added to the salary. So I have a brief table here which explains how our tax laws are monetizing the benefit in kind that is given to us. So for instance, if you work in an organization and the employer gives you a driver or a fully chauffeured car, you have a driver, vehicle, and fuel provided for you, the law is saying that you should calculate 12.5% of your total cash emolument and compare it to a maximum of 1,005 cedis per month and add it to your taxable amount, or use it as the valuation of the benefit in kind that you have received. So total cash emolument here will be your salary, and you add your allowances to it. Then you calculate the 12.5%. To what amount you get, you compare it with the 1,005. If the amount you get is higher than 1,005, the law is saying that you should keep that amount threshold of 1,005. You shouldn't exceed that. If it is below 1,005, then you keep that amount as the monetary value of the benefit for receiving driver, vehicle, and fuel as a benefit in kind. Where you have only a vehicle and fuel without a driver, the law is saying that 10% of your total cash emolument should be calculated and compare with 1,250 cedi a month and use it as the monetary value of your benefit in kind. If it is vehicle only that you are enjoying without fuel, without driver, it's 5% or a maximum of 625 monetary value per month for that benefit. Same goes for fuel only. So if you receive Tomcat with any amount on it, the law is saying that we should calculate 5% of your total cash emolument, compare with a maximum of 625 cedis per month, and use remain or stick to the maximum of 625 or lower as the monetary value for that. Moving forward, you may also have accommodation benefit as well. Some companies or some entities are able to offer accommodation with fully furnished facility for its employees, depending on how your terms of employment looks like. And the law is saying that here, 10% of your total emolument will be used as the monetary value for that and added to your compensation component and tax. If it is accommodation only, the law says 7.5% of your total cash emolument. If it is furnished house, maybe you have rented it, the company has furnished it for you, it's 2.5%. And if you are in a shared accommodation, it's also 2.5% of your total cash emolument. So what other deductions are applicable to employee which help to reduce your tax liabilities? So we've spoken about your salary, your allowances and benefit, which are the earnings that you make, which are put together. But there are also other deductions that the law requires that we take it out of your total cash emolument before we tax you. So these deductions do not attract tax. So your SSNIT contribution, an employee is supposed to pay 5.5% or 5.5% of your basic salary as a SSNIT contribution. The law is saying that when you are calculating your PAYE, you calculate this 5.5%, take it out of your total cash emolument before you tax whatever is left to tax. So this component is not taxed. Your employer is also required to pay 13%, and that one is a cost to the employer. So directly, you may not see it on your payslip as a benefit here, but it's a deductible expense for the company or the employer when they are also calculating their income tax liability. So you know that Provident Fund, which is a voluntary pension contribution under the Tier 3, also attract deductible expense, or the law allow you to deduct it from your taxable amount before taxing it. So just like what how SSNIT works, if you are making a voluntary contribution towards a Provident Fund scheme, and your employer is also making same for you, the law is saying that that amount should not attract tax. You should take it out of your salary. And the maximum percentage of Provident Fund the law requires an employee or an employer contribution for this tax deductible amount is 16.5%, meaning that if an employer is contributing 10% and you are contributing 6.5%, that full amount, when you calculate it out of your basic tax, should not attract tax. But instances, some companies and employees agreement are able to go beyond the 16.5%. And here, when you exceed that, the excess will not be deductible, or it will not be deducted from your taxable amount. It will attract tax. So the law requires that it be added to your taxable expense and also tax. So when you put the Provident Fund maximum percentage of 16.5 plus the 5.5% SSNIT contribution of the employee and the 13% of the employer, it adds up to 35%. So in all, if the employer contribution towards pension should not exceed 35% to be able to attract for it to be exempted from tax. Whatever exceeds that to be taxed. Mortgage interest, what is this? So per our Income Tax Act, an employee may go in for a mortgage facility with a bank, and that person will be paying interest on that. So the law is saying that that interest that you are paying, you can deduct it from your taxable amount before being taxed. And you are only entitled to one of these for a lifetime. So you cannot take more than one residential premises and deduct your mortgage interest out of your salary. It's only allowed for only one property. And wherever you are making any contribution or donation to a worldwide cause, which is approved by Commissioner General, the law also allow it to be deducted before being taxed. Aside the deductions, there are other personal reliefs that are in our Income Tax Act, which I'm sure most of participants may be aware, some may also not be aware, and some may be aware, but maybe they have not taken advantage of this to be able to reduce their tax liabilities, because these are reliefs that can help to reduce your taxable amount and thereby the tax that is being taken out of your salary at the month end as PAYE. So these incentives is a yearly incentives based on your year of assessment, and it's only applicable to resident or citizens in Ghana. If you're a non-resident in Ghana, you are not eligible to benefit from this personal release. So what are these reliefs? If you are an individual with at least a dependent of spouse or 2 dependent children, the law is saying that for the whole year, it's giving you 1,200 cedis as a personal relief. You can deduct this from your HR can deduct this from your taxable amount before taxing you, so thereby reducing your tax liability. So if you have a spouse or 2 dependent children, you are entitled to 1,200 per annum. If you are a disabled person and you have an approval from the social department to prove that or to support your disability, you can submit it to GRA and it will allow you to take 25% of your annual accessible income before being taxed. So if you are into any business or any employment income, the law is saying that if you are disabled, you calculate 25% of your income before whatever is left, you apply the tax on. So that 25% of the amount will not suffer any tax liability. If you are an individual of 60 years and above and working, the law is giving you 1,500 per annum as a personal relief as well. And if you have kids who are school-going children in a recognized institution in Ghana, approved by the GES, the law is giving you 600 cedis per child for a limit of 3 dependent children. So if you have 3 kids and they are all school-going children within Ghana, you are being given 600 cedis per child. So if you have 3 children, 1,800 cedis for the full year to reduce your tax liability. Whenever we have a parent and we send them monies or you give them some monthly amount to sustain them, and you're able to apply for this relief through GRA, this relief of 1,000 cedis per dependent. So if your 2 parents are still alive and you are providing for them, you will be entitled to 2,000 cedis in a full year to reduce your tax liability. The same way, if you are undertaking any course, professional course or vocational training, you have a tax relief of 2,000 cedis per annum to also enjoy and also to reduce your tax liabilities. So in a way of, if you are finding ways to reduce your tax burden or your income tax or PAYE on your pay slips, you need to see GRA or apply for these reliefs. And if granted, you can present it to your HR manager. Then these reliefs can be applied and reduce your taxes as well. So bonus payment. Whenever the year ends, our targets are reviewed and performance are assessed, and you are rewarded with bonus payment. The taxing of this bonus is also treated a bit differently. What the law is saying that we compare this, your bonus that you are being paid, the amount, if your bonus amount for the year, with 15% of your annual basic. So let's say your annual basic is 10,000 cedis. If you calculate 15%, that is 1,005 cedis, 1,005 cedis, yeah. And you compare this to your bonus. If your bonus is 3,000, it means that out of your bonus 3,000 cedis, 1,500 will be taxed at 5%. Any excess amount, the remaining 1,005, the law is saying that it should be taxed the same way as your accessible income. To be added to your accessible income and taxed using the graduated tax rate. So first 15% of your basic salary out as compared to your bonus is taxed at 5%. If it exceeds that, the excess is added to your accessible income. To end, we have a quote here which says that tax is not a punishment for the profit that you are making. It's just a signal that your business is alive and growing. So here our key lesson now is to learn how to manage it and not to fear taxation.